Good morning, everyone. My name is Chelsea Seiler. I'm so glad you're here to join us for this Women in Investing Masterclass. My co-presenter is unable to join us today, so I'll be here solo. I promise to keep it interesting and get you out of here within the hour. So today is our second Women in Investing Masterclass, and we're going to talk about a bunch of stuff today, starting with who the heck the BCSC is, what we do. We're going to get into the benefits of understanding your financial self and tips on building your investment confidence. We've done a lot of research here at the BCSC, and investment confidence is key. We're going to talk about AI-powered investing and touch on a few ways you can protect yourself from investment fraud, as well as where to get investment advice. And then we'll end off by sharing a few resources from us at the BCSC and answer some questions that were submitted and are frequently asked of us. So, who the heck is the BC Securities Commission? We often call ourselves the BCSC, and I know there's a lot of agencies with a lot of acronyms, but the BCSC is a Crown government agency responsible for regulating the investment markets in BC. We also protect investors from investment fraud and misconduct. So I'm coming to you from our offices in downtown Vancouver, where a lot of the companies we regulate are also located. We set the rules for trading securities, so things like stocks, bonds, et cetera, in BC. And we enforce the Securities Act, which is a piece of legislation, and we take action if necessary. We also educate investors about how investing can help you reach your financial goals and protect yourself from investment fraud, which is a big piece of what I'm doing and a big piece of why you're here today. One common misconception about us is where our funding comes from. We are not funded by taxpayer dollars. We are funded by investment industry fees. So that means that we are self-funded by market participants. Those are the companies that are issuing shares and people in the business of buying and selling securities. Money we receive from enforcement actions goes back to the investors who lost money, and then above and beyond that to investor education programs, like this one you're watching right now. As a regulator, we're watching over the investment market in BC to make sure that it's fair and dynamic. And there's a bit of a balance, as you can see on the screen here. We want the investment market to fulfill its role of providing money or providing capital to companies that need it, which of course helps lead to a more vibrant economy in the province. We also want investors to be protected from scams, unfairness, and people who are looking to evade the rules. So that balance is always on our mind here at the BCSC. And our job isn't solely to protect investors to the max, because if it were, our job would probably be a lot easier. We would simply ban average investors from taking all sorts of risks. But incidentally, that would also reduce their returns. So our job is more complicated, finding that balance, because we don't want to inappropriately stifle the flow of capital or money to businesses that need it. Our overall goal in BC and with our fellow securities regulators across the country is making a environment where people can invest with confidence and people and investors like yourself can flourish. Okay. So that's who the BCSC is. Let's get into it. We'll start with the basics. So not only when you start your investing journey, but while you're in it, your circumstances are always changing. So you start with the very basis. No one's investing journey is straightforward, and this is really important. No two investment journeys are the same. So it's important to know your own financial self. This means understanding for you things like goals, risk tolerance, time horizon, and investment knowledge. And we're going to talk about those things as well and what they are and how they impact your investing future. It does take time and it takes patience to build a long-term investment plan. So be honest with yourself and be open to learning, which you are. You're here today. We've seen through our research that overestimating investment knowledge can also lead to problems. So a basic question that women can ask to help you learn about your financial self is, are you an investor or a saver? It's a pretty simple question, but it's really important to understand. It's important because Our research shows that identifying yourself as an investor can make a big difference when it comes to managing your financial goals. People who identify as an investor are more likely to understand the risks and benefits of their investments, more likely to be on track to meet investment goals, and more likely to have an understanding of the fees and charges associated with their investments. So, one thing we see in our research is that women consistently feel the word investor doesn't describe them. Now, only 22% of women describe themselves as an investor. And we see that many more women than that are investors, but may not self identify as an investor. And it's really important that if you do invest, that you see yourself as an investor. What is the difference between an investor or a saver? So, very quickly, you're an investor if you have placed any money in a type of account or a product that has potential to earn interest, more interest than a traditional savings account would provide. You're a saver if you put your investments, pardon me, you're a saver if you put your money in a savings account and nowhere else. And it's not bad to be a saver. Investing can be a very effective way to have your money work for you and build wealth. But sometimes on the other side of things, holding cash and savings accounts are quite safe strategies. The difference is investing does allow your money to grow in value over time and benefit from long-term growth, but we'll get into whether investing is right for you. Now, you want to start off by setting goals. And this sounds so simple, but this is the fundamental thing when it comes to investing. Decide what you want to accomplish with your money or with your life and how money can help you get there, and when you want to accomplish it. Your financial goals are unique to you. So, whatever your situation, it's important to consider where you are now and where you want to be in your future. Setting those goals is a really important first step to being financially secure. Without goals, and this applies to anything in life, I think, without goals, it's harder to be persistent. It's harder to strive towards that better financial situation. But when you have that specific goal, you're more likely to take the steps to achieve it. Once you've figured out your goals, you start thinking about things like time horizon and risk tolerance. Time horizon is just that, the amount of time you have to meet your financial goals, and also time that you have to make up any losses you might incur. An investor with a longer time horizon may feel more comfortable with higher risk because they have that longer time horizon to make up for those losses versus someone who has a short-term financial goal who is less willing to accept risk. Now, your risk tolerance is just how willing or comfortable you are to accept risk. That's pretty straightforward, but understanding what your risk tolerance is a great start. So I want to go back to the research that we talked about, that we did about investors. And when it comes to investing, that confidence is key. And we're going to talk a little bit about the differences between men and women that shows up in our research that we do. Now, this is research we've done over 10 years of British Columbians. So it gives you a pretty good idea of where we're at. So we know that confidence is rising among women, which is fantastic. But women still feel less confident than men when it comes to making investment decisions. So 59% of women say, yes, I'm comfortable with my investment decisions, whereas 78% of men feel the same. Even with that increase in confidence, women still do feel more anxiety about losing money on their investments. So 51% of women say they're anxious. And women tend to be less optimistic than men that they will be able to achieve those financial goals and those investment targets. Women also have lower financial knowledge than men. So the research shows 56% of women have low financial knowledge compared to 38% of men. But, this hesitation and this pause can be a very good thing. Take, for example, that men tend to be more speculative investors. Speculative investing is a behavior that's correlated with higher risk. Among women, we consistently see less speculative type investing behavior. Women also periodically gain higher returns because they tend to avoid high risk trends. They can stay calm amid volatility, and they take a more passive approach to investing. So, while it's true it would not hurt women to gain more confidence in their investing, we don't need to be overconfident either because we already have good instincts when it comes to making smart investment decisions. So, try building on that confidence. You can start by getting comfortable with what your risk tolerance is. You are also doing that right now by attending this masterclass to build on your knowledge. There's always something to learn. Of course, just like building a house, a strong foundation is important. So, a strong financial foundation includes things like an emergency fund that can help you pay off unexpected expenses or avoid taking on high interest debt. Emergency funds are typically kept in a bank account that can be really easily accessed if needed. Things like car repairs, family emergencies, job loss, etc. Debt also plays a really big role in your financial position, and I'm sure this is on a lot of people's mind right now. But while investing is so important, it's equally vital to manage your debt responsibly. So, high interest debts, things like your credit card balance, can be such a drain on your finance. It's not that all debt is bad. Consider the debt you have and the debt you may want to take on in the future, whether it's a home, whether it's investing in an education, etc. And think about how that will affect your financial goals and your ability to invest. Someone who has a large amount of credit card debt may be better suited to pay off that debt before getting into investing. These are things to consider. When it comes to investing, start small but be consistent. And if there's anything you take away from this, it is what I'm about to say. You do not need to be rich to start investing. Consistency is key. So even if it feels like you're contributing a small amount, make it a habit of contributing that portion of your income each month for investing. Those small, regular contributions over time make a difference. And remember to embrace that long-term thinking. If you have that longer time horizon, for example, you might be in your 20s or your 30s, you have an option that others may not, taking on that risk that I mentioned earlier. That means that you can ride out things like market fluctuations. We've been hearing a lot about the market in the news right now, and it may be on your mind. And it could be an opportunity to capitalize on your investments. However, embracing risk, it is not the same thing as being reckless. Embracing risk simply means being informed, being strategic about your choices. It's also a time where you could experiment with different types of investment vehicles, things like ETFs, which are exchange traded funds, mutual funds, stocks, bonds. Learn from your experiences, thereby helping you make wiser decisions in the future. Investing is not a get rich quick scheme. Although people on the internet may make you think it is, investing is not a get rich quick scheme. You shouldn't be expecting instant wealth, but instead slowly and steadily gain progressively over a period of time. The historical performance of stock markets is undeniable. You should understand that market cycles have downward trends, but overall, the markets historically trend upwards. So even when markets are down, as I mentioned earlier, you may find an unexpected opportunity to enhance your portfolio, maybe even invest more, if your time horizon and if your risk tolerance can accommodate that approach. Okay, let's turn to AI investing. I'm going to take a quick drink. So let's start off with the basics. What is AI, artificial intelligence, anyway? So, AI is a type of computer technology that aims to mimic human like reasoning. AI is creating new opportunities in many fields, and I'm sure you've heard about it in many news stories. And one of those fields includes investing. Despite all the attention that AI has been attracting recently, it's not actually that new. Some AI approaches, things like changing a PDF into a Word document, are pretty commonplace, while others, things like generative AI, you may have heard of ChatGPT, have only recently become sophisticated enough and user-friendly enough for widespread adoption. Other examples of AI you can encounter in your daily life may include self-driving cars, language translation, photo classification tools, chatbots, I have strong feelings about chatbots, but we've all talked to them when trying to get customer service. So AI is out there. And AI is attracting interest from investors and investment professionals because it can analyze huge amounts of data quickly, which enables it to assist with researching stocks, picking stocks, potentially predicting market trends, optimizing portfolios, and more. Depending on who you talk to, some may argue that AI is less bias prone than human analysts. However, this AI software is pretty novel and new and untested over a long time. So, AI investment tools have the potential of making unwarranted conclusions. They may rely on sensitive data. They can make errors like any other piece of software. AI tools can be used to manage trades by monitoring market conditions and executing trades based on criteria that is set. It's important to note that using AI for these really fast trading strategies is extremely advanced, and most short-term traders lose money. Now, algorithmic trading, which is another form of AI, it uses a complex set of software and rules to analyze these large sets of data and make trades based on market trends. Most likely, this would be used by advanced market professionals and investment professionals, perhaps sophisticated day traders, but it's not for everyone. Okay. Now, if you want to use AI as part of your investment strategy and you were not intimidated by all those large words that come along with talking about AI, it's hard to simplify. Consider the following. Although AI can be a tool to help you achieve those investment goals, so going back to those goals that we talked about at the beginning, AI can be a tool to help you reach those goals, but you first have to know what those goals are. AI isn't going to fix that. And it's important to do thorough research before you make the decision to do AI. So, thorough research includes reading legitimate reviews, comparing platforms, potentially talking to a registered investment professional to get a better understanding of what's right for you. One thing that comes in handy, and I know we all have it, is our critical thinking skills. If something sounds too good to be true, it probably is. So AI tools can be helpful, but they're not perfect. When it comes to being a safer or protected investor, under Canada's regulatory regime, which means the rules that are set for investment advisors and dealers, professionals who are permitted to advise on investments, they must meet a certain standard and a certain criteria. So that includes things like education, background checks, reporting their status to a regulator on a regular basis. These requirements are set to provide investors with a safer, more equitable access to the investment markets. Now, AI is currently risky, untested, and largely unregulated. So keep in mind the difference there. And no matter what, don't rely on one tool alone and don't rely on AI alone. They are just tools, they're not magic. And whatever information AI provides, it's a good idea to cross-check it and use it as just one piece of your overall strategy. So we've covered AI. Let's take a look at the bigger picture and what options you have when it comes to making investments. There's more than one way to invest. You can use a registered investment advisor. I just spoke briefly about some of the rules that they operate under. You can use a robo-advisor, or you can look after your own investments through self-directed investing. Sometimes it's called DIY investing, but we'll talk about that in a minute. So starting with a registered investment professional. Registered professionals have a wealth of knowledge, wealth of experience, and guidance that can make a substantial difference in achieving those long-term financial goals. We're going back to the goals again. If you choose to use a registered professional, there are guidance and criteria that they have to follow, as I mentioned before. They play a really important role in helping you select suitable investments and managing your portfolio, and they have an obligation to know your financial situation and outline the risks for you. Investment advisors that sell securities must be registered with a provincial securities regulator like the BCSC. So you can always do a background check with the BCSC or the Canadian Securities Administrators, which is the umbrella organization that all Canadian regulators operate under. And you can do a background check to anyone who claims that they're registered to sell investments so that you can protect yourself from potential fraud. There are a number of things you can expect if you choose this route. Registered advisors need to make clear and specific recommendations. They need to explain how those recommendations will help you achieve your goals. Again, the goals. They must explain the risks involved with your investments, and they should answer your questions about investment products and strategies. If you don't understand something, ask for clarification until you feel comfortable moving forward with an investment. Remember, it's your money. They should get permission before buying or selling any investments and confirm it in writing, and definitely provide information about the fees you pay and the performance of your investments. Of course, other things like keeping your information safe, sending you regular account statements, and meeting with you at least one a year are also part of it. The value of good advice comes with a price tag. Your advisor's firm is compensated through fees and charges, and you need to know what those fees and charges are, what you'll get for them, and how you'll pay. So while those fees you pay will reduce your overall returns, remember that what you're paying for is expert guidance aimed at securing your financial future. So that's working with a registered advisor. There's also the option of doing it on your own. So you can either use a robo-advisor or self-directed investing. Robo-advisors, also known as an online investment advisor, they use technology to lower costs. So you would likely be offered a standardized portfolio that contains lower cost investments, things like ETFs. Because of these lower operating costs, robo-advisors can charge lower fees. Then there's self-directed investing, and that is when an individual investor builds and manages their own portfolio. So this is an option for highly active, highly involved investors because self-directed investors decide which investments they want to buy and sell and when. So if you say, I want to buy this stock, I want to buy this much stock, you are the one making that decision. And you're the one dedicating yourself to making sure the balance in your portfolio helps achieve those goals that we talked about. Self-directed investors tend to pay lower commissions and fees because they aren't getting that advice about the investments they choose. And you may consider this as a strategy if you're interested in being highly active, highly involved, and if you want to be more hands-on with your investments. Now, the investment market is extremely exciting, and unfortunately, fraudsters are out there taking advantage of this excitement. Right now on the BCSC's investor education website, investright.org, I'll mention that again, we have 21 different types of investment scams. That's a lot. So I'm going to go over 3 of them that are concerning us right now. Now, our research shows that a strong majority of British Columbians are worried about AI technology being used for investment fraud. 71% of British Columbians are concerned about that. And 57% of British Columbians are just as likely as anyone else to be a victim of AI fraud. That's what they said in our study. So bad actors are using this popularity of and complexity of AI to lure victims into scams. Fraudsters are using AI to perpetrate investment scams in a number of ways, things like imitating a legitimate person or thing. This can include deepfake audio, deepfake video, websites. They may be creating unregistered platforms that claim they are using AI to generate guaranteed returns, and they may make false claims about their use of AI technology. You may have seen or heard our advertising campaign right now that talks about AI investment fraud. It's a catchy little song that might get stuck in your head. Another scam that is gaining traction right now doesn't have the nicest name, but we call it a pig butchering scam. So this scam involves online relationships, pretty much. Fraudsters lure individuals into the relationships to build trust. So perhaps you think you're making a friend while you're playing Scrabble online. And this friend of yours may say, I have an investment opportunity that I made a lot of money in. I can get you in. And typically they're offering a pretty high investment return over a short period. They may even take your money and show you a return to increase the likelihood that you'll invest even more. So what happens is this trust is built, this money is exchanged. Once they are hooked, once all your money is in that account, that friend who is actually a scammer suddenly disappears, and the victim has no way to get their money back. So this often happens with things like romance websites, dating apps. Often it's crypto that's offered as the investment opportunity. And if you're wondering where the term pig butchering came from, it's derived from the idea that a scammer will fatten up their victim with the promise of those lucrative returns before slaughtering them for their money. So, a very unpleasant name for a very unpleasant scam. We also are seeing a recurring scam that re-victimizes people who have fallen for fraud. So if you think it's bad that you've been defrauded, there's actually people out there looking to defraud you again. So you may have lost money on a scam. You may be embarrassed to tell people that you lost money on a scam. You may not want to tell your spouse. You may not want to tell your siblings. So let's say you've lost money to a scam. All of a sudden, someone's coming up to you online and saying, we can help you get that money back. It may be the same person who scammed you in the first place. It may be someone else completely. But the idea is that you pay a fee to get your money back. And unfortunately, the perpetrators take the money and the investor loses again. So these are really serious investment frauds that are happening to a lot of people. And the best way to protect yourself and your family from becoming a victim of investment fraud, things like steering clear of investments that offer a guarantee of high returns and no risk. So any investment has some risk. And if someone's telling you can get really high returns for little to no risk, it's a really big red flag. Also, don't let FOMO get the best of you. Fraudsters are skilled at making it sound like their offer is making other people really rich and you're not in it. Make sure you clock that a fraudster might be preying on that emotion of FOMO and pause. And then if someone is pressuring you to invest, if they're rushing you, if they don't want to answer your questions, that's a red flag. You should always have time to do your due diligence on any investment or any investment offer. And of course, if you suspect investment fraud, report it to us. The sooner we're aware of the fraud, the sooner we can take steps to stop it. And I mentioned, and I want to mention again, that some people are avoiding reporting that they've been a victim of investment fraud because they're embarrassed. There may be shame involved. It's important to have the courage to report the fraud so other people don't fall victim to it. So I would encourage having these conversations with your family to talk about how to protect yourself from fraud, but if it has happened to you, how to report it. So that concludes the educational component of this webinar, but now I'm going to share a few informative resources to help you continue your empowered investor journey. So we talked about building that confidence, building that knowledge. We're here to help. A key goal of the BCSC is to empower investors like you to protect your financial interests and to become better informed about investment products and services. So we do this through our website, which provides unbiased investing information on investright.org. This website provides you with tools and information to help you make wise investing decisions. And all of the information on InvestRight is based in research. So we have a whole bunch of tools and resources, but I want to highlight a few of the key ones that you may be relevant to you. And it would definitely make sense to start with this one. We are on a Women in Investing Masterclass, and we have a Women in Investing guide on InvestRight. This was specifically designed for women. And some of the research I mentioned earlier went into making this resource. So there's research-backed information that aims to bridge the gender investment gap and instill confidence in women when it comes to making informed investment decisions. There's also a section where women here at the BCSC tell their investment stories, and some really great stuff on there, and I'd encourage you to spend time there. We also have a video resource that's divided into two parts. It's called Get Started with Investing. So the first part will take you through the basics, and then the second delves into more complex investing topics like the private placement market. So Get Started with Investing is there as well. InvestRight also has a whole bunch of calculators, which our web traffic shows that the public is really interested in. It's good to spend time on them, plug in different numbers and see how things impact. For example, your retirement. The retirement calculator can help you estimate the total value of your investments at retirement and how much money you could have during retirement. We also have other calculators like investment returns and how to calculate fees, etc. So I covered most of the fraud warning signs, but you can certainly learn more about the 5 key warning signs in more detail on InvestRight, so you can protect yourself from investment fraud. Now I'm going to jump into some of the questions that we get often, and then also some questions that were sent in specifically for this masterclass. And I super appreciate those of you who sent those in. So the first question that we get a lot is, can the BCSC get my money back if I have been a victim of fraud? So the answer is that the BCSC does have the power to make orders relating to money and enforcement. For example, before hearing, the BCSC can issue orders to freeze funds. And after a hearing, if someone has contravened the Securities Act, the BCSC can order that person to pay the BCSC. Any funds collected under this type of order would be repaid to investors. So when we talk about the Canadian regulatory regime and using trusted investment platforms, this is part of it. If you are using an unregistered platform, the chances of getting your money back is a lot smaller than had you gone through a registered platform or advisor. So next question, which investment account should I use? And we also had someone in particular ask about investment accounts in retirement and their impacts on taxes. So first of all, I am not a registered investment advisor, and the BCSC cannot give investment advice. However, there are a few options when it comes to investing accounts, and the one you choose will depend, guess what, on your financial goals. So I'd suggest going to InvestRight and checking out our Understanding Investing section. There's some information on there you might find useful. Of particular interest to the individual who was asking about taxes, it's good to read the pros and cons of registered accounts, things like TFSAs, RRSPs. When it comes to taxes, the type of investment income, so things like interest, dividends, capital gains, return on capital, etc., the source of the income, whether it's Canadian versus a foreign company, and the type of account, as I mentioned, a registered account like an RRSP versus an unregistered account, all those things impact taxes. But again, check out our Understanding Investing section, and you may want to reference a registered advisor to help you further. So we get a lot of questions about crypto. Understandably, it's everywhere right now, or it feels like it's everywhere right now. So crypto, things like Bitcoin, it's just computer code, and it usually has little or no connection to cash. So access to the crypto market has become readily available to pretty much everyone. But because it's available, it doesn't mean it's the best investment option for everyone. We talked about risk tolerance and knowing your own risk tolerance. Well, crypto assets are high risk investments, and they often come with little or no investor protection. And that's what I mean when I say it's not for everyone. Crypto can be bought and sold on a crypto asset trading platform. These platforms may or may not have controls to keep your money safe, and many exchanges are based outside of Canada. That said, if you do want to pursue crypto, it's a smarter decision to use platforms that are registered with Canadian securities regulators. They have some obligations around safeguarding customer accounts. You can see a list of the current crypto trading platforms authorized to do business with Canadians, along with banned crypto trading platforms on the Canadian Securities Administrators website. And speaking of crypto, we received another question that I'm going to touch briefly on that involves a question about opening a personal crypto wallet. So whoever asked this question, I'm going to make the assumption that they understand their risk tolerance. They understand that crypto is a high risk investment, and they're interested in opening a personal crypto wallet. So what is a crypto wallet is a good thing to start with. A wallet in reality is just 2 sets of numbers and letters, and those sets of numbers and letters are called keys. The first key being a public key, The second key being a private key. The public key is an address that anyone on the network of crypto assets can view, and you can view transactions associated with that wallet. The private key is a secret set of letters and numbers that should never be shared with anyone. It allows the holder of the key full control of the crypto assets in that wallet. Generally speaking, a public key is similar to a username, and the private key is similar to a password. So that's the basics of crypto wallets. And opening a crypto wallet on the blockchain network is complicated and requires quite a bit of coding knowledge. There are two types of crypto wallets. We have hot wallets, we have cold wallets. Cold wallets are safer from hackers, but they come with their own set of risks because if that private key that I mentioned is lost, that crypto cannot be recovered. Now, there are many apps that simplify the process by creating and managing crypto wallets on your behalf called Wallet as a Service. So if you have an iPhone or an Android, you could download an app. We certainly do not comment or advise on safety and security of these apps and do not provide merits of buying or investing in this type of crypto, but there are tutorials that help you understand how to use these apps. One app is called Blue Wallet. There's other similar apps available. So if you want to store crypto assets in a wallet and use one of these wallet provider apps, again, it's important to do thorough research, not just on the asset in question, but on the application who's providing the wallet service. Have I lost you? That's it for crypto right now. We're going to move on to another question that we received asking, is there a difference between an advisor at a bank versus an investment firm? The answer is yes, there are some key differences. Bank financial advisors typically offer a more limited range of financial products. They may focus on everyday banking and insurance. They may offer investment products that are limited to the bank's mutual funds, GICs, etc. The range of products offered may be more limited, may be tailored to the bank's offering. Whereas financial advisors at an investment firm, and remember that these advisors need to be registered, all of them. Investment firms typically have a broader focus on investment management, wealth planning, so they can offer specialized advice, a wider variety of financial products, usually on a more personal level. Advisors at investment firms generally specialize in a wider array of options, stocks, bonds, mutual funds, ETFs, other wealth management services, and they may offer a broader selection. Investment firms tend to focus on growing and managing wealth rather than just providing those basic financial services. So when you're choosing your advisor, whichever one you choose, consider your specific needs, and we'll go back to your specific goals, whether you require basic investing advice or more advanced advice, etc. And keep in mind that all these registrants have two fundamental regulatory obligations to clients. The first is a suitability obligation, and that obligation means that this person is required, person or firm, to determine if the action that they're proposing is suitable for you based on a number of factors. So, for example, let's say that you tell your advisor that you need to access your money in a year because you would like to use your investment to purchase a home. A suitable investment would not be one that prohibits you from accessing your money in that time frame. The second obligation is to resolve conflicts in the best interest of the client. So that said, it's important to educate yourself on one of the ways you can educate yourself is reviewing your account opening information. There's a ton of different relationship disclosure documents, etc. And this is the reason why the BCSC has these rules, and that is to help keep you and your money safe and fair access to the market. So very last question, what should I invest in? Well, I'm the wrong person to ask. As I mentioned, the BCSC does not recommend or give advice on investments. However, we can do things like answer general questions about investment products, investment services. We can tell you if a firm or representative is registered in BC. We can tell you if the BCSC or another provincial securities uh, regulator has disciplined an individual or company. We do that through something called the investment caution list that we maintain and update. And we can offer suggestions for pursuing a complaint or tell you which organization may be of the most help. So a lot of people want to know, what should I invest in? And our advice would be, the first thing is to go back to the beginning and start with, what are your goals? What is your risk tolerance? What is your time horizon? Choose between, would you like to use a registered investment professional? Would you like to use a robo advisor? Or are you interested in being highly involved as a self-directed investor? Finally, we'd love for you to keep in touch. If you'd like more investing information, please join us on investright.org. You can also subscribe to our monthly newsletter at InvestRight. We send out once a month informed information about investing topics, investing trends, and then follow us on social media. We have a really fun Instagram account that you see here on the screen. And in honor of International Women's Day, we'll be soon posting some information focused on women and investing. And as I mentioned at the beginning, we see that women have lower investing confidence, but there is a way to build that. And we do know that women have all the tools and capabilities to invest. And we're really happy to be here to support you, to empower you, and to teach you how to keep your money as safe as you can. So thanks for joining. I wish you all the best on your investor journey, and I look forward to staying in touch as we move forward. Thanks again for attending. Have a wonderful day. Take care.